welcome to the Global View on this Friday. Well, British companies reported a marginal return to growth in November after 3 months of contraction, but the downturn in orders continued as businesses dealt with higher interest rates and weak demand. The Composite Purchasing Managers Index spanning services and manufacturing moving into expansionary territory. And the downturn in the Eurozone business activity eased in November, but not enough to suggest the bloc's economy will contract again this quarter as consumers continue to pull back on spending. Demand fell for a fifth straight month, while manufacturing activity, which has contracted every month since July last year, fell again, while services rose slightly, but also remain in contractionary territory. And preliminary surveys showed recession in Germany may be shallower than expected, which offset a downbeat read of French business activity. Well, Eurozone inflation is falling as expected. That's according to the minutes from the European Central Bank's last meeting. Policymakers saying overall the process of disinflation seemed to be proceeding largely as expected. If anything, the disinflation process was proceeding somewhat faster than expected. Well, the US Treasury market was closed for Thanksgiving Day, but futures trading implying a rise of the 10-year yield from 4.41 to 4.48%. And the euro edged higher after that data, suggesting the downturn in the Eurozone economy may be easing. The Aussie dollar trading at 65.6 US cents. Well, fair to say, of course, treasuries have been volatile. So is this the new norm? And if it is, what's that mean for investors? Do you need a total strategic rethink when it comes to bonds? Mark Todd is joining us from Bank of China. Mark, a very good morning to you.
Morning, mate. How are you?
Very well. Of course, not a lot to go on last night, just in terms of the US markets being closed, but where are you seeing those, particularly those US Treasuries heading at the moment, with the prospects, of course, that the Fed is done and then markets trying to price in the first rate cut?
I think a lot of people imagine, like, I'm sure you're aware of the Turkish central bank going to 40% for 1 week repo, and then said it was a dovish hike. So I think the world is anticipating that central banks will be more dovish and will be looking to, either ease or keep rates where they are and not necessarily continue to lift them. But what's clear is that the market takes a different perspective. Now, that could be a timing thing where they think it'll be in 2024, then they change their mind and it won't be in 2024. But what has been obvious throughout this year is the level of volatility relative to everything else and relative to how it had performed. So I think the way that, I'm starting to think about it is I wonder how the 2024 allocation will go. So let's assume for 1 second that throughout this year that we knew that rates were going higher, and it's only in the back end of the year did we see that maybe they have stopped. So we've still seen hikes. Maybe they'll stop. Look at Australia, another hike. So there is volatility this year, and we knew what was happening. So 2024, we don't necessarily know what's going to happen in terms of the timing. So one of the things that I'm thinking about is, if you are a sovereign fund manager, what is your trading strategy? So we all know that hedge funds have got into, the volatility of the sovereign curve. But is that the sort of organization that's going to get an allocation from a multi-billion-dollar fund like CalPERS or, the Future Fund or whoever? I just don't see that being a place that somebody in those big institutional flows will look to play. So to my mind, you're going to have to try and find a fund manager that has adapted to the volatility. So, you can buy treasuries, and everyone is aware of it. You can buy govies and buy leverage, put leverage into it, 3 times levered, all that sort of stuff, 10 times levered. Every regulator on the planet is worried about that. But because of that volatility, what's trading between 2s and 10s, 3s and 5s, if you're a much more active sovereign trader, you might actually be able to do pretty well, get equity-like returns, in the 10s, in the 12s, that sort of stuff, because of the volatility. So I think the thing to look out for is those fund managers, of which there will be a handful at most, who've had experience in this last year of looking to build models that can start trading that volatility. And that's the one you've got to try and find. They're out there in the market, so everyone's got to do their research. But that's probably the main game for 2024 as it relates to sovereigns. We're trying to take advantage of the vol.
Regionally, though, where are you looking? I mean, you mentioned there Turkey, the central bank there. It's dovish
Oh,
hike of
at 40%.
40% rate.
Yeah,
Then, of course, you've got what's going on in Argentina at the moment.
Argentina. Oh my goodness.
New president who's literally promising to blow the place up and
Yeah,
start afresh. So look
and then
there,
you've got the Netherlands.
and the Netherlands. You've got the shift to the far right that we're seeing in Europe at the moment. So where do you look?
And don't forget you've got two elections that will take place that are going to be pretty important. It's going to have the UK and you're going to have the US this
Mm.
year. So if you think about that politics, about what's happening, there is clearly a cry from people for some sort of change around whatever the disparity they see, whether it be they want to blame the cost of housing, whether they want to blame inflation, whether they want to blame people that are moving into their suburbs. I don't necessarily have an answer on what that's going to do, except to appeal to people who will say, I have an answer. And of course, do you have an answer to things that are incredibly complex, like the movement of people? So, I wrote last week about the debt crises that are taking place in Africa, in Argentina, in Southern American states is really important because it means that if they can't solve it, the IMF and China in concert with Saudi Arabia, with all these big funders, if they can't solve how to do that funding, and one of it is, I think China is saying we need to really think about how we're all equal in this. So the Paris group will have to take a haircut just like we take a haircut. So think about it that way. Until they can get those sorts of things solved, that's a real problem because people will leave. If it's catastrophic in Argentina, if it doesn't work, what do you think people will do? They'll move. They'll go to other countries. And so then you're starting to say, hang on, shut my borders, don't do this, all that sort of stuff. So that's why it's really important to try and get the solutions domestically in whatever country you are. So whether it be in Netherlands or wherever. But in terms of investments, I can't help but think it's, buy Aussie, sell US. I just can't help but think that's going to be the trade that people will look at. Really modern economies, really substantial regulatory environments, really interesting dynamics that take place between the fiscal story, us and them. That whole story of surpluses, that whole story about the fiscal pulse that is going through, and then the transmission mechanism. If you think about the millions of homes in America that have an under 4% 30-year mortgage, who over the last 3 to 5 years have got outsized pay rises, and telling those people not to spend. That's the theory. That's what we're going to do. Wow, that is really hard to do. And so Australia's got this different transmission mechanism. It's inflation is going to be a different story. So you'll start to look at that and say, America's going to issue a lot. Australia's got a better position. I just can't imagine they're not going to say, buy Aussie, sell US,
Yep.
buy Japan, sell US. I just can't imagine that's not going to be a thematic over time.
Mark, just on the US, of course, that inversion between the 2 and the 10, which opened up as of July last year, often seen as that
100%.
harbinger for recession, of course, has closed more recently, of course, given what we've seen in the rise of the 10. How accurate is that? I mean, given the prospects for recession? No?
Not at all. I mean, I really feel that, the point I guess I'm trying to make at the start is we need to think differently about how we think about these curves and how the traditional mindset around how those curves are providing evidence of something is really giving it more credit than you might want to when you think, to be honest, a lot of it is just the herd. You see these trades where everyone's going into it, whether it be hedge funds, whether it be, any type of fund, sees that the market is going long and the momentum trade is to go with that market. And you look at that, got to 110. It's then moved back into at one stage, I think it was about like 39. The movement in that to suggest that somehow that's changed, like somehow in that 6 months that the economy is somehow different is, that's probably giving them greater credit than they probably deserve. In October, the 10 years got to 5%, and now look at it. And are you telling me that since October to November, something has happened in the US economy that suggests that rates are going to ease, everything's fine? What are you telling me has happened when the entire time that the Fed has said is, oh, good news, but we're not changing at all? And think about that vol from 5% down to 440, moving around. that is not giving you credibility as I know where this is going.
Well, Mark, from a global perspective, Australia's not a bad place to be.
Great place. Except it's raining, but it's a great place.
Yeah, well, this is where you are. Mark, enjoy your weekend. Thanks for joining us, Make of China.
Thanks, Andrew. Take care. Bye-bye.
Cheers. All right, just before we go, a check at the market, where we're likely to get going in just a couple of minutes' time, as you can see there. In fact, it's up almost 1/5%. Stay with us. The open is just a couple of minutes away.